Hey, Tyler,
Yeah, Jason.
it's finally happening.
Are we finally fixing Jack Welch's mistakes?
Yeah, I think that's really the meanest possible way to put it. But yes, very soon, possibly it may have happened after you've watched this video. GE will be completing the last of its planned spin-offs with GE as it stands today, getting split up into GE Vernova, which is its utilities and energy-based business, and GE Aerospace, remaining the existing corporate legacy GE.
It's about time.
Yeah, it's you made the quip about Jack Welch, but the reality is that we are 2 decades after Welch retired from GE, and it's taken a ton of that time to get back to what investors are hoping is a GE that can execute, deliver, and create value instead of being this product of financial engineering that the company had become. I'm Jason Hall. This is Investing Unscripted. We're going to talk about what's happening, and we're going to talk about which of these two businesses we each prefer going forward. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link. You see it on the screen. It's fool.com/unscripted. Okay. Get your pen ready or get out your phone and open up notes. Here it goes. Fool.com/unscripted. Go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. Okay. So there's a lot of hindsight bias here. And honestly, it's easy to dunk on Welch and GE 24 years after the fact, but I want to share this on the screen, Tyler, because I think it's so impactful. This is from roughly the top, August 31st, 2000, a little bit less than a year before Welch retired. That's GE stock over 23 and a half years. Now you add in dividends and spinoffs, and you've made a little tiny bit of money, but opportunity cost is absolutely massive. The S&P 500 has increased 5.5 times over that period of time. So anybody that owned or bought GE near that peak, continually waiting and waiting and waiting for the company to turn around, has lost a lot of money and missed a lot of opportunities for better investments.
I think it's a pretty unconventional take to say that Jack Welch was a bad manager and was ultimately bad for GE because 20 years ago he was considered the manager of the century. And they wrote jokes on 30 Rock as a testament to like how good he was. But we look back on this time and there was a lot of kind of just basically fitting parts together into a single business and saying that because our specialty is basically cutting costs and running things efficiently, we can do this with any business. And so you saw in 2008, right around the time when things really started to get hairy for the company, it owned cable companies. It owned Comcast, it owned NBC, it leased airplanes to commercial aircraft, it owned healthcare. You could basically name any business under the sun, and it owned it. Oh, yeah, it even had one of the largest banks or credit card kind of companies in the world at the time, to the point that GE was considered too big to fail and was actually under like this, what was it, like the systemically important financial institution?
Between its industrial lending and its consumer finance, it was one of the biggest banks in the US, one of the biggest lenders in the US. It's remarkable. I do want to give a little bit of credit because this is his legacy at the peak from when he was hired as CEO. The stock went up, almost 23,000%, right? 23,000%. So certainly a lot of value created on the way up. And even for anybody that held through that terribly brutal period of time, we're still talking about 17,000% in total returns. So on the way up, certainly created a lot of value, but on the way down, destroyed a significant amount of value. And we've already seen, and I think this is an important part of it, the company by fits and starts did do things over time. Synchrony Financial, for example, that's the former GE Capital. I'm going to age myself and date myself a little bit, but prior to my financial analyst days, I worked for some companies that manufactured industrial equipment. And every one of those companies that I worked with, who one of their prime lenders was that they partnered with, it was GE Capital, right? So it was so far beyond its industrial manufacturing roots. And the financial crisis certainly upended a lot of the business, but also competition and financial engineering instead of focus on actual engineering. I don't want to say it was Boeing before Boeing, but in terms of a focus on the wrong part of delivering returns, that's the story of GE. Now, let's talk about what's happened more recently, what's about to happen, and then where we think investors might want to consider looking.
So a few years back, basically what happened is they brought in a new CEO, Larry Culp. He was the first like true outsider to the company. He came from Danaher, which for those who don't know, Danaher was also been not an industrial conglomerate, but a conglomerate nonetheless, who was very good at acquiring companies, rolling them in and being very efficient and returning a lot of value to shareholders that way. But once he got in, he basically started like gutting things and put in this plan to break up the last remnants of the company into three things. What we've since seen is there was the jettisoning of the oil and gas business back to what is now Baker Hughes. We saw the spinoff of GE Healthcare, which was last year, and then next week. And the reason we're doing this video now is because we're seeing the last breakup, which is going to be the separation of GE Aerospace and GE Power, or GE Vernova is what it's going to be. And Vernova is basically the collection of its legacy power businesses, so gas turbines, coal steam turbines, nuclear facilities, as well as turbines for wind power and electrification, grid resiliency, a lot of the kind of behind the scenes stuff that brings that power generation to the home eventually. And as part of the separation, it's taking what I would say is the stronger business, having it shoulder the burden of kind of the indebtedness of the business that's remaining and giving the power business a shot in the arm to do better because it has been historically over the past few years the weakest part of the entire GE portfolio, including the healthcare portion that was just part of it last year.
Here's a quick slide on the healthcare portion. We're not going to talk very much about it, but just again, this is healthcare equipment, manufacturing things like imaging, like MRI machines, ultrasound equipment, that sort of thing. This is a breakdown of where the revenues for GE Healthcare come from. That's really all I want to say about it, besides that this is a business that certainly benefits from some secular tailwinds, the aging of the baby boomers, and it's a global phenomenon. It's not just a North American thing, and that should steadily provide room to continue to grow the business at higher rates than GDP. So that does position the business pretty well for the long term. Let's talk a little bit about the aerospace business. First here, Tyler, between the two new businesses that are going to emerge, I'm not gonna bury the lead here, but I know between the two, this is one that you in particular think is pretty compelling. So right here on the screen, $32 billion in revenue. The majority of that comes from commercial business. I'll let you talk about some of the details here. But of course, it does have a pretty healthy business with defense industry as well. And this is something right here in blue that you can highlight. And that's, I think, maybe one of the things that might be most appealing about the business is that services revenue.
Yeah. eh, Both of these businesses, both GE Vernova and GE Aerospace, they both are, for a lack of a better term, that razor and blade model that has been used frequently in business, where basically you sell the really big piece of equipment up front and then you get to monetize on the small disposable thing afterwards. It's
Now,
not
unlike
100.
unlike some of the razor companies that sell the razor at cost, they do make good money on the quote unquote the razor, but the margins are extraordinary on the blades, on the services, on the recurring revenue part.
Exactly. And it's weird to say that the jet engine is the razor and the services are the blade, but it's the same idea, right? Where
Yep.
whenever somebody buys a jet engine, they're signing up to a service contract, a maintenance, repair, and operations contract with GE to maintain the life of that engine, because that every engine on a plane is expected to last 40 years or something like that. And as a result, that's where the real cash flow and where the real money comes from, because it's a much higher margin sort of entity. Typically, on the sale of the hardware, you maybe will get a single digit operating margin, mid single digits, maybe high single digits if you're really knocking it out of the park. But once you have a really established base, you're going to have a much higher margin profile. And that is why personally I'm a little bit more of a fan of the aerospace business in general, is because there's a much, much larger established base already out there and currently being serviced and has very high service revenue, about 70% of it on the commercial engine side and more than half on the defense side, which it doesn't mean that commercial engines is not growing. GE happens to provide engines to Boeing, Airbus, Embraer, Bombardier, as well as the Chinese company Comac. And so basically anybody that's making a commercial airplane right now outside of Russia is using a GE engine. And they're pretty much dominant compared to Pratt and Whitney, which is and Rolls-Royce, which are the other two competitors. And
Well, the other thing too, and RTX Pratt& and Whitney's kind of dealing with some issues right now, some recall issues where you're gonna have to inspect and service an Airbus plane in the next couple of years to replace some parts. So there are some things right there that I think competitively position GE pretty well. Plus, you said this is not no growth. We do know, and anybody that's followed the Boeing story over the past 5 years, it's been incredibly frustrating because the secular opportunity as demand for commercial aviation grows has seen this massive missed opportunity there, and GE is positioning itself as a pure play at a pretty good time to benefit from that tailwind as we see demand continue to grow for commercial aviation. And with the events in the Ukraine, concerns about global unrest, there's certainly continued focus on spending by defense entities around the world at the same time. That positions GE to be a winner.
now, I don't want to discount GE Power or GE Vernova as not a good business to own. But the thing that is going to perhaps in the coming years make it look a little bit less attractive relative to its aerospace peer is that it doesn't have as much of the established base in, for example, in wind turbines. And so with it massively growing out its wind turbine fleet that has not yet gone through significant service cycles, you're going to see a lot of kind of single digit operating margin kind of sales on turbines for a really long time until that service revenue really starts to kick in. There is an established power base with its gas turbines and with coal-fired engines, but that is a we'll call it a slower growth, even slower than commercial airplanes business. And with wind taking up so much of the kind of the future potential for this business, it's going to be a little bit more challenging for the company to produce the higher margins that we might expect to see at GE Aerospace.
Yeah, the reality is that just the wind and on the screen here, 49% services for its existing backlog. That may grow some, but by and large, wind is just a lower touch sort of thing. It doesn't require the level of maintenance that you're going to see in the aerospace business. The power business, like I said, massive backlog, but that backlog is stretched out over decades. So it's not going to be a super driver of growth, like you said. The thing to me that's interesting about GE Vernova is the balance sheet's going to be pretty strong once the spinoff is done. And I think that can help make up for some of the maybe lower services margins that they won't necessarily benefit from. But the other part of GE Vernova that I think you need to be aware of too is cyclicality, particularly the wind side of the business and the electrification as well, as its customers go through capital cycles where demand can ebb and flow substantially. And when business does slow down from the peaks, manufacturers like GE Vernova lose operating leverage as revenue goes down and their fixed operating costs weigh on the bottom line. So that's a reality that's going to potentially affect the bottom line at periods. It could create opportunities to buy the stock at really discounted value prices, but it doesn't look like we're going to be walking into this separation with that kind of value point.